Welcome to the Galp Q2 results presentation. Overall, this quarter we saw a favourable macro, although challenging in some business segments. We achieved robust operational performance, leading to strong results. The macro remains extremely volatile, with Q2 seeing rising oil prices, elevated gas prices and oil product cracks. These are unprecedented market conditions, and Galp's asset base is well positioned to capture this strong macro. Upstream production was softer, as anticipated, although we still saw very strong financial results. Equally in refining, but there we achieved high utilization rates. Commercial oil volumes are still also recovering from the pandemic, but still below 2019 levels. We also enjoyed increased capacity, higher generation and strong solar capture prices in renewables. This strong operational performance in the second quarter led to a strong RCA Ebitda surpassing €1.2 billion and an OCF close to €1 billion. Working capital reflected a natural build from the increased commodity price environment. Still, we started to release some of the temporary working capital related with derivative hedges. In Q2, we already released €200 million and we should release the remaining €630 million by year end. Despite the working capital build, our free cash flow reached almost €500 million, allowing for a clear deleveraging trajectory. I note that OCF minus CapEx was over €700 million. And ultimately, net debt at the end of the quarter was €2.2 billion, with net debt to Ebitda already well below 1 at 0.7. I'll now quickly run through the performance of our different divisions. In upstream, production was lower than in previous quarters given increased concentration of maintenance. Unlike the first quarter, there were many shutdowns in Q2, mostly planned. However, the offshore situation is improving in terms of logistics and POB, but still there's a lot of work to do. We expect this to be the weakest quarter in production terms this year, and we keep our guidance unchanged with production this year in line with last year. But more importantly, there were increased realizations both in oil and gas. Upstream Ebitda almost doubled to €878 million. Of course, there was also double the taxes paid in Brazil and Angola, as you can see in our OCF numbers. We also made good progress on our projects. Coral FLNG remains on time and on budget, an excellent performance, and the operator has already connected the first gas wells to the processing units, with the first commercial cargo expected in the fourth quarter. In Sao Tome and Principe, we're finalising the Jaca well operations. The well was safely drilled and we're now analysing the data. And in Bacalhau, together with partners, we're also making steady progress, adding an additional drilling rig. Looking forward, there are still exciting options with our upstream portfolio. We are progressing Namibia, now planning an exploration well for next year or 2024. In commercial, we saw a gradual demand recovery, now also in B2B activities, where aviation and bunkers demand is increasing towards pre-COVID levels. The retail segment recovery remains understandably under pressure, and Galp has rolled out discount campaigns to mitigate the impact on the prices to our loyalty customers. We recently increased these discounts in our summer campaign. I'm also happy to see the transformation of this legacy business starting to really show results. Contribution to Ebitda from convenience retail increased 25% year on year. All in all, commercial Ebitda was up by 33%. And looking forward, Q3 is the summer driving season, so should be supportive on volumes. Galp is actively developing decarbonisation solutions for our clients. We just announced the first delivery of sustainable aviation fuels in Portugal. to tap. Focusing on mobility solutions, we've been increasing the pace of our EV charging network deployment. In Q2, we had 1,500 charging points, on track to our target of 2,000 by end 2022. Galp's industrial performance is improving, both in terms of safety and reliability, as we continue to implement a very strong safety culture. European refining margins rose significantly as demand continues to recover, whilst EU sanctions on Russian products, combined with limited refining capacity, put pressure on prices. We saw record high diesel cracks. Our refining system was fully available, performing at maximum capacity to capture the favourable environment to keep the markets well supplied. We managed to secure access to VGO supply alternatives, as since the end of March, no VGO has been imported from Russia. The strong refining contribution in the quarter was offset by yet another negative impact from the time lag in the oil price pricing formulas. In periods of steep variations in commodity prices, customer prices structurally lag the assumed input costs. Also, our energy management team continues to deal with persistent restrictions from gas sourcing, leading to weak gas trading contributions. And this quarter, we had to buy LNG at spot prices, which translated into a negative Ebitda margin. Looking into the rest of the year, we're expecting product cracks to remain quite high, at least for the summer. This should continue to support refining margins. And we expect to perform some planned maintenance activity in Sinish during the fourth quarter. However, we maintain the 90 million barrel guidance for raw materials processed during the year. On our industrial low carbon projects, namely the HVO project in Sinish, we make good progress, particularly on developing partnerships to address our feedstock sourcing strategy. We also qualified for the EU Recovery and Resilient Fund support for our HVO and hydrogen projects, which is still subject to negotiation with government. We achieved strong renewable performance in the quarter, benefiting from additional capacity, seasonality, and high availabilities, with all PV plants now fully operational. We currently have 1.2 gigawatts under operation, all sold under merchant conditions, capturing the current market price environment. In the quarter, there was also good developments on our Aurora JV with Northvolt, and after selecting Setúbal for our lithium conversion plant, we have qualified now with others in the value chain for the Portuguese Recovery and Resilient Plan. Important steps for this project, a relevant one for Portugal, and completely aligned with the electrification ambitions in Europe. Now, looking ahead, we're progressing rapidly to de-risk our portfolio and get our projects into a ready-to-build stage. In fact, we believe we can have more than 800 megawatts reaching that stage of maturity still in 2022. However, securing licensing and development permits continues to be our main bottleneck. By the end of this year, we estimate that we'll have 1.4 gigawatts operational capacity online. Today, we're pleased to announce that we have acquired the remaining 25% stake in Titan, the solar PV joint venture initially established with the ACS Group. Titan holds our entire solar PV projects under operation, almost 1.2 gigawatts, and a large pipeline of projects under development, now 1.6 gigawatts, all in Spain. The acquisition terms were compelling, but more importantly, assuming full ownership of these assets will allow us to unlock more value, including new financing, risk management, and accretive moves such as hybridization. Cobra will remain as the main EPC provider with adjusted execution terms to align with the market conditions. Galp's total pipeline is maintained with a robust position to achieve more than 4 gigawatts operating capacity by 2025. In summary, we're making good progress to deliver on our investment proposition. Galp is well placed to deliver strong growth from well-established businesses as well as on the low carbon front. We have a robust financial position, which should see increased distributions in line with the current distribution framework. Filipe will go through the details of our outlook shortly, but I see Galp at year-end generating close to 3 billion euros of OCF, and therefore 2022 distributions will be close to 1 billion euros. Until then, we're delivering on a 150 million buyback program related with 2021 and expect to pay 26 per share in September, corresponding to half of the 2022 cash dividend. I'll now pass the floor to Filipe, who will cover the financials of this quarter and the updated outlook. Thank you very much.
Thank you, Andy, and thanks for watching, everybody. Financial highlights. Group Ebitda was strong, over 1.2 billion, with all businesses contributing. And because we report in euros, we also had US dollar tailwinds. Upstream Ebitda of 878 million was up 9% from last quarter, and that despite the lower production. OCF was close to 600 million, given all the taxes we pay in the countries where we generate those good results. Commercial Ebitda, 97 million. This was supported by the gradual post-COVID recovery in oil volumes, and particularly in B2B, with aviation, marine bunkers picking up very nicely. Industrial and energy management Ebitda was 283 million, with our industrial assets working flat out to capture the very strong refining environment. But we had another 50 million or so in price lag effects in our oil supply business, so we're not passing on to clients the rising commodity prices as quickly as our own input costs. We also continue to have gas sourcing restrictions, so we had to tap the spot market to purchase more expensive gas during this quarter. This was a 65 million euro hit in Q2. On renewables, we are not consolidating here, so we focus on the pro forma indicators. Ebitda was 62 million in the quarter, with higher generation capacity online and higher irradiation, given seasonality. Now, with the recent acquisition of the remaining stake in Titan, 100% of this business will now start to flow through our consolidated P&L and cash flows. Now, on the P&L, we have within EBIT impairments of some 85 million euros, and this is related with an exploration asset in Brazil. Associates' contribution includes the strong performance from Titan Solar. Financial results include some 330 million in mark-to-market swings on our still outstanding Brent and refining hedges. Now, from that, we have about 130 million related with Q1, which had been booked as special items. For clarity, we book as special items only the mark-to-market of derivatives which we enter to cover client positions. All this leads to a RCA net income of 265 million. Operating cash flow was strong at 964 million. Now, this is the metric we focus on, as it reflects the underlying fundamentals of our business, and OCF is also a key parameter for our distributions framework. During Q2, we had a large working capital build. This is because of the commodity price environment. However, this was partially offset by the roll-off of our hedged gas exposures, so we had about 200 million that have now come back to Galp. The balance of the still open positions as of June 30 was 630 million in margin accounts, and this should gradually be recovered fully until year end. Net capex was 244 million in cash terms. This compares with 224 in economic capex, which you will find in our report as well. And the difference between the two are timing between billings and the actual payments. Free cash flow was 488 million, which after dividends and buybacks allowed for a reduction in our net debt of about 200 million in the quarter. So net debt to Ebitda is at 0.7 times, even with 630 million tied up in the margin accounts. Now we have adjusted our full year guidance, now expecting group Ebitda of about 4 billion euros. Now this assumes Brent of $90 per barrel during Q3 and Q4, and we keep our production guidance unchanged. Now bear in mind that around 3.2 million barrels of our upstream production for the rest of the year is hedged at $80 per barrel. Refining margins have already come down during July, and here we also have about 11 million barrels of our throughput hedged at around $8 to $9 per barrel for the remainder of 2022. On renewables, we will start consolidating fully the renewables business from now onwards, and this should add some 60 million to our group Ebitda related to the second half of the year. And overall for the group, OCF guidance is 2.9 billion. Capex remains unchanged at about 1 billion, even considering the Titan 25% acquisition. Net debt to Ebitda should remain well under 1 times, already considering the onboarding of Titan's net debt of about 220 million. Now, given our 1/3 of OCF distributions framework, this should imply over 500 million euros in buybacks next year. Thank you.